All right, so today we are going to go through and review everything that we've talked about previously and just kind of go do a nice little run through and make sure we've hit everything. And then we'll also discuss, towards the end, we'll discuss hiring an advisor, what kind of things you might want to look out for, or how you might want to check in with your current advisor, conversations to have. So we made it. We made it to the end, 12 long weeks, lots of content, lots of very detailed information. If you didn't catch everything the first time around, that's totally fine. That's what the book is for. That's what putting these classes up on the website is for. And that's what learning on your own is for too. So we started by looking at a couple different goals that you might have with your financial strategies, with your financial plan, some things that you might do. So some of those things would be maximizing retirement income, growing your estate, reducing income taxes, inflation protection, financing some travel and entertainment, actually doing something with that money you spent so many years building up, distributing your assets properly, funding children's education, protecting the accumulated assets, making sure they don't go anywhere and that they stay in your hands and able to do what they're meant to do. We dove into our version of the financial planning process, our simplified three-phase process, where we start by reviewing your current situation and strategizing looking forward. Our second phase, where we build the portfolio and make sure that everything is allocated in the proper direction. And phase three, maintaining the plan, making sure that you follow it, that we follow it, that everybody's on board, and that it stays in line with your goals and objectives, and make changes when it is necessary. So in phase one, we talked about the diagnostics. We talked about cash flow, how you might look at your different expenses and all the things that you might want to think about when we're looking forward into planning for future expenses, how it's possible that in retirement expenses can drop, but as we know, insurance and cost of living goes up quite substantially these days, so it's smart to plan ahead for that. A couple different current expenses that we could be looking at: mortgage, health care, groceries, all your monthly utilities, everything to do with your car, all your insurances, and leisure activities. Because a lot of people don't end up budgeting leisure in, and then when you want to go do something, you don't have the funds for it because you never budgeted for it. So make sure you understand that you might want to, take some more time for yourself in retirement as well. And then calculating how much your income and expenses should be in a few years, in a decade, in a couple decades, so that you can have a better idea of how to allocate your portfolio and how to work your plan. We ran through the insurance diagnostic, which is really just topping up on everything and making sure you have as much coverage as possible, especially when you really can't afford it. In your higher earning years, everything should be maxed because we're protecting assets at that point. We want to build up our pile and we want to keep it and not let things take it away. So medical, very obvious one. Long-term disability, to make sure that if we are unable to provide the income that we've been working so long to create, that we can fill that in. Long-term care, as we know, we've talked about some examples with some clients that have had really, really high long-term care costs. One of $200-something thousand a year because she wants to be comfortable in her own home. So understanding what that might look like for you and how you might want to budget for it, and making sure that you have insurance to cover that if possible. Life insurance and its uses, obviously it becomes much more useful when you're in a situation where losing a person would mean losing an income source. That's where that ends up being the most important. But we also talked about, very briefly, some estate planning that you could do with a life insurance policy in a trust specifically for that. Homeowners and auto, we talked about maxing those all the way out so that we can now have the option to get an umbrella liability policy that covers the entirety of your portfolio. Make sure that all assets are accounted for within that. So if you've got a $2 million estate, make sure you've got a $2 million umbrella policy. And remember that $2 million is really just, you can subtract all of your home and auto insurance from that, and then that's your real extra liability that you're getting on top. So if you max out your home and auto to $500,000 a piece or something like that, and you get a $2 million liability policy, you're adding on that extra $1 million of coverage to make sure that your assets don't go anywhere. We talked about the estate planning diagnostic. Talking about how wills can be helpful, especially as a little bit of a catch-all for personal property. or useful for a small estate when you don't really need a trust. In fact, there are some states that have small estate affidavits that make things a little bit more simple, where just a will is going to be perfectly fine. Trusts are great for a much bigger estate especially, and they're most useful for when you want to give that really specific instruction, like we mentioned with the spendthrift provision or spendthrift trust, which lets you have very, very specific ideas of what you want to have happen with your funds, how they're dispersed, when they're dispersed, and with what requirements. We talked about beneficiary designations, how important it is that for everything you have beneficiaries designated on all policies and all accounts, because if it either is not going to go to the trust or a beneficiary directly, ends up going through probate. In California, that averages like a 2-year process, and they can charge you 1% of your assets just to have the privilege of not doing it the way that you want to do it. So it's all bad news when we go to probate court. So we talked about how important it was for us to avoid that by using beneficiary designations, transfer upon death, and that sort of thing.
Can you review briefly? We had a client come in, his wife is entering dementia stages.
Mm-hmm.
And so he came in to become a client, but there's a lot of legal issues here, right? Can you mention that she's a trustee on their trust, but she's losing awareness. Very young, by the way, losing awareness. So should she stay on as the trustee of the trust? Should she not stay on? Can they do this? Can they not? Can he sign for her? What were the issues you ran into?
So the things that we were running into, and this is where these power of attorney documents will become pretty important. With this particular example, we had this trust where both of them were trustees, and when you have multiple trustees, often they have to agree with each other, and that's how they're going to make the decisions, and they sign off on things. And in California, something that's interesting for estate planning that we learned recently while we were talking about this is a durable power of attorney cannot override a trustee power. So if she became to the point where she was completely incapacitated and she was unable to sign in any way, she wouldn't even be able to resign as the trustee because that signature would not be able to be trusted. So there would have to be some additional steps to go through. So the problems that we were running into was she's like in this between period where she's not completely gone, but she's also not completely there. So it was kind of a gray area for us to be taking her signature on documents, be looking at these different things. And so what was really important for them for transferring in accounts was that there was a durable power of attorney previously set up before this condition was ever even known. So that when we got to this point where we don't really know if we can trust her signature or trust her capacity to sign things away, we know that that power of attorney document can step in, and the husband was able to sign for her so that accounts could be transferred in.
And he would usually get a letter from the doctor saying she's incapacitated.
Well, that would be the case if it's a spring forward durable power of attorney. If it's simply just a regular durable power of attorney, it will go forward anyway. Yes.
So you're saying the power of attorney was predated?
Yes, it has to predate the condition because she has to sign the power over to him. Like she has to sign the document that gives him the power to sign for her. So otherwise, you'd end up looking at a guardianship type program, something where some third party deems her unable to be able to make her own signatures, in case you would get guardianship.
The spring forward provision, so he doesn't have a right to just say, I have power of attorney, unless the document says you do right now, but it usually says only if I'm incapacitated, get the letter from the doctor, then it triggers it, right?
Right, yeah, so a spring forward will always be.
Under certain conditions, yeah, because most people aren't going to give your spouse power of attorney over yourself, right? Only if you're incapacitated. That's the spring forward provision that Nash is talking about. But if it does spring forward, he becomes the power of attorney, he can't fire her as a trustee. Right?
Yeah, so without other intervention, that was the problem with her being the trustee on the account, was that in California holds higher than a power of attorney does. So you can't use power of attorney to override her power as the trustee.
So what we mentioned is see your attorney. If the attorney looks over everything, he or she will do a letter, resign the
Yeah.
trustee anymore, co-trustee. He's the only trustee, or maybe with his kids. Then he can do the power of attorney. He can manage everything for her.
Yeah.
But we see it and then we go, okay, I can't go any further with this. You got to go see the attorney at that point. But it was interesting.
Yeah.
I learned that she can resign, and we'd rather have an attorney confirm that, right? Do it with an attorney. She can resign, and then he can take over power of attorney for everything.
Probably because it wasn't conditional. That would probably be the reason. Because if she still has capacity to resign, that would mean that the durable power of attorney was always in effect. Like
Okay.
if he's able to sign for her and she has the capacity to resign,
Right.
that would mean it's not spring forward.
Right, so that's where it gets to be, for us, dicey. We're not getting involved. We send you to the attorney. But at this point, what he said.
Yeah. So she was deemed competent enough in order to resign. So that was good news for us because she was able to come off the trust. Then we know we're just dealing with him as the trustee. He has no problems, and then they get their they get co-trustee, contingent, blah, all that fun stuff, your backups and backups. But since she was able to resign, and the power of attorney was able to be in effect also, which probably means that it was not conditional. It didn't need a letter from the doctor. So then he was able to sign for her on the IRA documents and stuff like that.
Okay, good.
Yeah. So that's why these power of attorneys are really important, and it's also important to keep checking and make sure everything is still right, because if we hadn't even mentioned that, this trust had not been amended since 2008 when it was made, and she developed this condition. They didn't do anything to make sure that this was going to be all right, while she was just maybe right when she got her diagnosis would be a time that you go, oh, we should probably have her resign off the trust. Yes.
I'm down, but I'm just going to ask questions. The power of attorney, is that automatically part of your trust? Is that in there? You have your trustee
Usually.
as a person?
Yeah, you'll find another chapter in the back of the binder.
I need
Yeah.
to go read that.
Yeah, it's
Yeah.
there. The only thing I have a hard time getting my head around is it only springs forward if you are medically incapacitated.
Yeah, if it's a springing power of attorney.
Yeah,
Yes.
and this lady could have said, I'm barely good enough, I can just sign over my power of attorney to my husband, but we just don't want to get involved. We leave that between the attorneys. So, the thing about this stuff is, when we mention you need this and you need that, you may already have it. So what are you going to do?
Yeah.
You're going to pass it on to your kids. Tell them you need this. And I've had people bring the kids in and make me lecture on them. So, you know, you've got to do this, this, this. Even if you're fully retired, we're talking to your grandkids or your kids now. Keep it in the family, right?
Yeah.
Oh, you do the lecture?
Yeah.
Right.
I've had clients that have me send the kids in and I give them a hard time. You go to do this. Your parents say, you know, whatever. But not everybody, but some we do that.
Yep. Really just kind of talks about why you need to have these power of attorney documents, especially if you're in a situation where you, like you and a spouse, it's important that you have those documents prepared so that if something happens to one of you, then the other one can take care of things. We talked about our tax diagnostic, where there's not really much we can do to avoid taxes, but there are sure some ways that we can bias towards things that are more efficient or simply that make us have to do less work at the end of the year. Some tax-advantaged investments, talking about mutual funds versus ETFs, and I actually dove into the subject of how ETFs do not pay out their capital gains. I did a bunch of reading on that. While he was presenting at Sierra College, I was on my laptop furiously Googling away. And it's really interesting how they make that work. Because the way that it works is you're always going to have with an ETF an authorized participant. And so that is usually some big firm with hundreds of millions or billions of dollars, and they're ready to go. What happens is the authorized participant and the creator of the ETF company, or the ETF company, will enter into an agreement to create this fund together. And what the authorized participant has the obligation to do is to go out into the market and purchase up all of the securities that are going to be held in the ETF. So they go buy all the stocks. Let's say it's going to be, let's just make it easy. Let's just say we're going to have a fund that invests in Tesla. That's what we're going to do. So the authorized participant, usually some really big firm, will go buy 100,000 shares of Tesla. Now they own this Tesla, and that's part of their agreement. So the ETF company then creates its shares, its ETF shares, and they swap them. They just exchange them. The authorized participant gets the ETF shares, same value, and the authorized participant gives the Tesla shares to the ETF. The way that the authorized participant hopes to make money is hoping that when they go buy the stock, it's going to be at a slightly lower price, and then they'll sell the ETF shares in the open market. And additionally, what this is doing, when the authorized participant gets to play that arbitrage game of hopefully buy the stock at $99 and then sell the ETF shares at $100, the more that they take that money out of the market, the more efficient the ETF gets. And it matches the price of the underlying holdings better. So the authorized participant is actually, by making their money and by going and buying the stock and then selling the ETF shares and doing this back and forth, they make it more efficient. So that's why we like to have a lot of volume in our ETFs. It's because we know that there's trading back and forth. We know that people are buying these ETF shares from the authorized participants, and the spread will get lower, and the value will get closer and closer to what the underlying holdings are. Yeah.
Is there any advantage for, say, the bank who initially owned the stock, buying the ETF from the person they're selling the stock to? I mean, I can see where this could create a few issues.
Yeah, it could, but it's like when we get down to it, there ends up being like the difference ends up being so minimal, and there's so much of that arbitrage going on that it gets priced away. It basically just gets completely priced away, which is good for us as investors because because ETFs can trade at a premium or discount, because it's not like with a mutual fund. At the end of the day, they recalculate their net asset value. That's how you know how much your ETF shares are worth. They look at everything they're holding, and they go, what's the net value of all of this? They recalculate it, and then they divide it by how many shares are out. And that's how you get your value. But with an ETF, the fund company does not determine the value at all. They don't calculate it. They don't do it at all. It's simply, where can you buy it from? Who is selling it? Who's got it right now? So with the authorized participant stepping in, discrepancy from what the stock underlying is selling for versus the ETF shares, they basically clear out any premium or discount, and then we get to buy it at the proper value.
And in doing so, they make a fraction of a profit. Like
Yeah,
half a penny.
yeah, they just will make a little bit, because what they'll either do is, if the ETF is currently trading slightly above the value of the assets within it, they will buy more stock, and then they will swap it for ETF shares, and then sell the ETF shares. But if the opposite is true, they will go buy ETF shares, and then they will exchange it for the stocks inside the ETF and give some shares back. Then they'll sell all the stocks. So it's this game of what's more valuable right now, the stocks inside or the ETF shares. Whichever one it is, give me that, and I'm going to go sell it. And I'm going to buy just keep arbitraging over and over again. That's what keeps ETFs efficient, and that's what keeps them from having any tax liability, because if the ETF gets Apple stock in, $100 a share, and they give out their ETF shares, and now it appreciates to $200, all they're going to do is they're going to go, great, we want to buy NVIDIA now. And they're going to exchange that with, they want to tell the authorized participant, hey, we want NVIDIA now. And they go, great, we will go buy some NVIDIA, come back and go, hey, can I have your Apple? Sure. Swap it, no sale, no tax, no distribution to you. So
it's kind of like being a resupplier to Walmart. If they have all the stuff they need to sell, but if they get short and they don't have access, they'll contact their authorized participant saying, we need more of this, go find it, and we'll buy it from you. And then there's an exchange.
That sounds so much like closed-in fund. Transaction is not that much difference. Except it's
Although the assets can be much lower or higher than the share price. That's the whole point here, is the authorized participant's going to come in and buy and sell and bring the spread back to the actual net asset value.
That's why I like closed-in funds.
Yeah, like a market maker. Yeah, you like being out there where there's risk. But then again, if you hold it forever, you own those shares, but you may or may not have paid too much for the price per share, and the assets are worth less.
I always buy a discount.
Okay, and wait it out. Okay.
yeah. So that's what's really interesting about ETFs. Now that I understand that more, it makes a lot more sense. And then mutual funds is just, mutual fund is almost like you own a little share of an investment company or something like that, investment club, like just buying and selling. And it's like the business transactions just all come out to you.
I was
the profit and
assuming,
loss.
but you can confirm they don't distribute capital gains? Or
ETFs?
Yeah, or
They can.
They can, but
They
don't
almost
have.
never will, because they will almost always do this exchange. However, the authorized participant can also simply offer cash. They can simply pay them cash, and there's a sale. So that's where a capital gain will happen.
But why would they do that then, right?
Right, so they wouldn't.
Okay.
So almost never will you see a capital gain distribution, but it technically can happen because they can just offer cash and say, I will give you cash and buy your ETF shares.
And the ETF never has to sell shares. Like at the end of the day in 2008, when the market's crashing, everybody runs to Vanguard. Hell, get me out of the S&P 500. They have to buy your shares. And if there's not enough money coming in to buy your shares, what do they have to do to get you your money? They have to sell stuff, triggering capital gains, right? But in this case, if it's Vanguard's ETF 500.
No, they don't do anything at all, because the only people who do that are the market makers and the authorized participants. Those are the ones that you're actually going to be transacting with. That's the closest you'll ever get to actually buying from an ETF company. You won't ever buy directly from an ETF company, because they will always, just like a broker does for an IPO, it's the same thing basically. It's just like how if you have an IPO, they make a commitment to sell so many shares, so they give the company the shares and then they go sell them. Usually the broker or the dealer or whatever will pay a certain amount. If it's a firm commitment, they'll go, great, we're just going to buy this amount and then we're going to go try and sell them all. Or they might have some, I forget what the names of the other stuff are, but there's different ways that they can do that. But it's kind of very similar with an ETF. It's almost like an IPO, where they give the shares to the authorized participant, and then the authorized participant is the one that is under the obligation to go sell them and make their money.
Most ETFs have like 4, 5, 10 authorized participants. They'll
Something
let
like
go
that,
and
yeah.
Bring things to them. Amazing. It took me like 20 cartoons of ETFs to try to figure this out. He reads one article. Oh yeah, I understand it all. Makes it good.
So yeah, we talked a bit about that and what the consequences actually for you as an investor, because all that information is super great and helpful. But what we really care about is ETFs aren't going to give you a giant tax bill at the end of the year. So use ETFs if you need them. We talked about how a tax-deferred annuity, both fixed and variable, can be helpful in a tax situation if that's what you want to do. However, you can also just do it yourself. But if you don't really feel like doing all the work, if you want to grab yourself a fixed annuity to just put some money in there, defer some gains, and then get it back out when you annuitize at the end, good on you, go for it. Just understand what you're paying for and what you're going to get. We talked about tax-deferred investment vehicles, stuff that you would have been familiar with throughout your career, like an IRA or a 401k, and how helpful those are, where you get tax deferral now, you get non-taxable dollars today put in there, and then you pay taxes on the way out, versus a Roth account, where you pay taxes on the way in, and you don't pay taxes on the way out. Now, obviously, mathematically, if you've got the time, the Roth account makes way more sense, if that sticks around forever. Because if you have time, if you have lots of time, all of those gains becoming tax-free could be huge. I remember seeing in the news, I forget exactly what the amounts were, but there was that one guy who put tons and tons of money into his Roth account. He maxed it out every year, and he ended up with like billions of dollars in this Roth account, and he just took it all out tax-free because there's no taxes coming out of a Roth account, off of a Roth IRA. So whatever investments he made, I don't know if it was $15 million or $1 billion or whatever, but it was some ridiculous wad of cash that was way more than every contribution he ever made. Only paid taxes on the way in. Now he's got like $15 million or whatever the amount was, and he just gets to take that tax-free, no hit.
Now they're trying to change the law to where wealthy people can't do that. Right?
Exactly, because it was way too good of a system. So that's why it's good to get your kids to open Roth accounts and just, no matter how much it is, put something in there, buy the aggressive investments, run it up, have fun, go for it. That's where you want to do that, because that's where you'll get the best benefit. Because if you see really good returns, if you're investing in growth assets or small stocks or whatever, and you see these huge returns, you don't pay any taxes on any of it. Sounds like a good deal to me. Yeah.
Do you have to take a
RMD?
first one? Yeah.
Nope.
That is kind of sweet.
Yeah, it's
Well, actually,
just,
the law says Ken has to.
oh, right, exactly. Just you.
You have, just you. 529 plans can be now converted to a Roth for that beneficiary.
Yeah, I believe so in some cases. I think that was part of Secure Act 2.0.
Okay.
Yeah.
So if you have an old 529 plan, didn't get around to using it, you could use it for anybody in the family for education, but if you want, you can convert it to that beneficiary's Roth.
Yeah, if I remember correctly, it's like a one-time dollar limit sort of
So
thing.
the beneficiary has to have a Roth where you can transfer it into.
I guess so, or maybe you set one up, but either way, the concept is, if you have one grandchild, let's say, and you put all this 529, they got scholarships, they never used it, you don't want to pull it out and pay tax on it, you can convert that to a Roth IRA for their benefit and let it go on for their retirement. That's amazing. Yeah.
What's this, 529?
Yeah, the old education 529.
Oh, they're still around a lot today.
Oh,
It's like the primary, well, actually the other ones are the ones that have gone away.
Okay, so
It's the 529 is the one still
Okay,
around.
Parents, and I used to have a joke for the class, what's the best educational funding for grandkids? And everybody looks around. Grandparents, right? So you can put money into a 529 plan, an investment for the child. Each state has a different one. But then it grows tax-free for those children until they're in college. It's still tax-free. If they pull it out and use it for tuition, then it's never taxed, right? Is that right?
Right.
529.
Yeah, so 529s, they're essentially like HSAs, but for school, which is really nice because you get, it's almost never, it's never taxed basically if it's used for the proper things. Then after a certain point, it becomes penalty free, but you pay taxes on it, kind of like a qualified retirement account.
Yeah.
But I actually have the information on the conversions. So you have to own the 529 for 15 years before you can do this rollover.
Okay.
And let's see, any contributions within the last 5 years before the distributions don't count.
Okay.
So first you have to own the plan for 15 years and look back of 5 years, all of that money doesn't count. So it has to be basically older than 5 years and you have to have had the plan for 15. And it is, your rollover can't exceed the annual Roth contribution limit. So you have to do it just in the contribution limits every year,
Okay.
up to a total of $35,000 lifetime. So it's only 35 grand.
Lifetime?
Yeah, 35,000 lifetime. I was thinking it was more like 60 or 70, but no, $35,000.
The thing on the 529 is you set it up and you have somebody as a beneficiary, and then you or their adult parent can be what do they call a trustee or somebody that's in charge. So you could, if you have an adult child, say, here, I'm going to put this for your child, my grandchild, and then you're the manager or the trustee of it, and then you can contribute, and you can get all other family members to contribute that limitation. But they just took the fun out of the conversion.
Yeah, so that's some hefty requirements, but anyway. So then we also got into our portfolio and investment diagnostics, where we looked at our big three important pieces: suitability, risk tolerance, and objectives. Starting with your objectives, making sure that we know what the purpose of our investment is, whether we're biasing towards growth or yield, interest, dividends, or if we need a lot of liquidity. Looking at our risk tolerance, understanding what our emotional tolerances ourselves are, and also how much of a risk tolerance we need to have in order to grow our assets to be for their use. Understanding how much time we have left until our distribution, which clues us into how much risk we can take and how long we have to write it off. And suitability, making sure that everything follows your investment preferences. If you want to be more socially responsible with your dollars, that's fine. Just make sure you know what you're investing in, because index funds may have a little teeny tiny little toe in something you don't like. So just look through your holdings. If it's really, really important to you, it's important to look at the underlying holdings of funds as well. Making sure that the investment quality is high, making sure there's decent enough volume, it's a good management team, it doesn't cost too much, and it does what it says it does. Not a whole lot more to it than that, but just not overpaying for the same thing you can get otherwise. Like when we were looking at trying to come up with options for people who don't need investment management, but we just want to hold some funds on the side. If the account is too small in a brokerage account, we get dinged for it being a small account and they have to pay an extra fee. But then if we go over to a mutual fund only account, which is what I would hope to offer, the only thing that's in there is one no commission S&P 500, and I think it was like 50 to 80 basis points management fee for an S&P 500 fund, Or you could just open a brokerage account at TD Ameritrade or whatever, or Fidelity, and get it for, actually, if you open a brokerage account at Fidelity, they have zero cost funds to get you in the door. So if you really don't, if you don't have a lot of money, you don't want to spend anything on fees, go to Fidelity, look at their zero funds. They've got a few. They've got more. I mean, they've got more in there than they did S&P 500 funds in the mutual fund account that I was looking for. So that was interesting. Also taking into account your sophistication. So it's important to understand the investments that you get yourself into, because otherwise you won't even know if they're suitable for you. So if you don't understand the investment, it's probably not suitable for you. That's where having a professional also be able to explain things to you in a way that you understand makes sense. But you want to make sure that you're up on everything that you're invested in so that you at least know that it's the right thing for you, even if you don't understand how it works completely. Now we moved into phase 2, my favorite part of everything, where we build the portfolios, using time to select investments, all we talked about, using the different stages. More time equals more risk, more liquidity means less risk, all that fun stuff. Making sure that we balance between liquidity and time to give us our proper risk tolerance that we can take, or like a maximum that we can take. And then we talked about our types of risk, the types of things that we like to manage against. So we've got our diversifiable risk over here, all of those specific things that you can kind of think of. These would be things that would be most relevant towards individual stocks or individual bonds. And these are things that we can diversify away by just having a bunch of different types of stuff. If we have 1,000 different stocks, we have a much lower chance of one particular company being a drag, versus if we have 3 stocks, one of them goes kaput, there goes the third of your portfolio. And then we have our systematic or non-diversifiable risk, and that's the stuff we can't make go away, but we can manage our tolerance to it with our lateral integration, with your risk tolerance, by knowing how high do we want to crank the meter. So basically, for the market risk, how high of a beta do you want to have? What kind of standard deviation are we looking at? How long do you have? What kind of, just all those different things come into it. And then obviously inflation we can't really control, but we can try and manage it by having more equities to beat that inflation rate. We talked about how we implemented lateral and vertical integration. So our stage 1, mostly cash, short-term bonds. Stage 2, some broad index or low volatility, maybe some min-vol funds or value funds, a little bit longer-term debt. And then we've got our more aggressive, growth-oriented stuff in stage 3 for our long-term. And we talked about our vertical integration of how we like to diversify, starting with our total market low-cost index funds, biasing all the way to the super cheap stuff where you can find these, again, some of them for zero if you're at Fidelity, and even if you're not at Fidelity, their total market still costs 0.015%. So that's my favorite at the current moment. We got your sector, factor funds, and maybe some asset allocation funds. So if you want somebody to do the allocation for you, you might put a little bit in there. You got your managed funds at the top. Could be your growth, could be a Franklin Dynatech, T. Rowe Price Capital Appreciation, some kind of managed income fund, all those sorts of things. You'd have that at the smaller top of the spectrum, just so that you're not paying a lot of fees. Because we want to bias towards the low fees and then sprinkle in some higher fee stuff for flavor. Takeaway from all of that was that creating your customized portfolio requires allocating properly for your needs, as well as diversifying between different funds and fund companies to make sure that we're not taking on any individual risks that we shouldn't be. So to address both of these, we use lateral and vertical integration. Lateral for your needs and vertical for diversifying between companies and funds. So each portfolio will be unique both to the person and to the person's needs and risk tolerances. So in fact, you could have accounts like if you have a 529, that's probably going to be allocated different than your retirement plan might be. If you have a individual brokerage account that you use to, save for short-term expenses, that might be allocated differently than your IRA would be. Depending on the purpose of the account, it will be allocated differently. So if you have a whole bunch of accounts, you can look at them as a big picture and assign specific uses to each one of them. That's how I like to do it anyway. That sort of division between the accounts helps me visualize better how I'm going to actually use the funds and how to create my overall portfolio. We had a basic allocation guideline where if you just absolutely had no idea where to start, you could pick a few funds, follow this broadly, and it should put you in a relatively good place in terms of your assets. And then obviously you can tweak all of these numbers. So if you have no cash needs, or if you're young enough that your retirement plan still has a penalty on it, you could basically crank stage 1 all the way down to maybe 10% and push more of it into stage 3. Same thing with the layers, but we always like to bias towards the very bottom, which would be your lowest cost. We went over modern portfolio theory statistics, stuff that you would see on a Morningstar report, and how to understand things like beta, alpha, and R squared. So quick reminders on all of those. Beta is pretty much how risky am I compared to the equities in the stock market? How close am I to taking on the same level of risk? If your beta is 1, you pretty much look like the S&P 500. If your beta is 0.5, pretty much half of that. If it's more, obviously it's more. Alpha talks about any excess returns that you would get on top of what you should be expecting from the beta. So if you have a beta of 0.75, but your returns look like as if you had a beta of 1, well, there you go. You got some alpha on top of that. Good for you. And then R squared, pretty much how similar are the movements to the index I'm comparing to. So if I'm looking at real estate, that's going to have a low R squared compared to the S&P 500 because they don't travel in the same direction. But a total market and an S&P 500 are going to look very similar because those top 500 companies are pretty much what drive the market anyway. We talked about some bond-related metrics. First of all, your average effective maturity, but more importantly, average effective duration, which basically is just a factor of both the maturity and the interest rate that the bond is paying at the time. And the average effective duration is basically a measurement of your interest rate sensitivity. For every percent that interest rates go up or down, you could multiply that by the duration. That's about how much you'd feel. Interest rates go up, you go down by the factor of your duration. We talked about credit rating and where the split happens between what's called investment grade and high yield or junk bonds. Obviously, higher is better, but as you go higher, because there's more of a guarantee that you will actually get your money back, the interest rates become lower. So the interest rates get higher and higher the lower you go down, which is why people like to sit around this BBB mark, because you're still considered investment grade, which means good enough for investors, but you're getting sweeter yields than you would on AA's or AAA's or government bonds.
Are you familiar with floating rate funds?
Not super.
There's floating rate funds out there, mutual funds called floating rate. Sounds really good because they rise and they fall with the market. So if interest rates go up, they go up and so on. But they buy low credit rated commercial loans at the bank with contractors and things like that. And for whatever reason, we move clients in a little bit of floating rate, and they tend to be investment grade. Some are lower, some are higher, and the rate is good if rates go up, and not so good if they go down. So when rates went up, these floating rates became more popular. But you want to watch out for a floating rate. It could be too good to be true for a while. I have a couple clients. We have them in T. Rowe Price floating rate or Fidelity floating rate. We're up 11.5% in a year. The yield is about 6 or 7, but the popularity is another 5. And you could lose that popularity overnight. So if you hear floating rate, no matter what it is, if it's too good to be true, and it doesn't mean it's not true. I know people that have bought junk bonds for the last 35 years, and they probably did as well as the stock market. But there's years that it's really ugly. So a floating rate fund sounds like a money market fund. It's really low credit rated, fairly short-term maturities, and that's fine until 2008 rolls around, and they're going to take a big hit. So they're great. We have them in the portfolio, but on a very small percentage.
So after we looked at how to evaluate investments and what they might be useful for, we then talked about the purposes of your investments and what kind of objectives you might have, going all the way from current income, cash flow today, all the way down to maximum growth, which is the absolute most growth and volatility that you would expect. And most people end up falling somewhere between balanced and growth and income for the most part, just because that's generally kind of that middle of the road. When most people are looking very intently at their investments. Usually it's either when they need to start taking money out or pretty close to that. So that's why, for the most part, a lot of people will be between that growth in income and current income section. We also talked about risk tolerances and a few different things that you might identify with, all the way from conservative, which is not tolerating large market fluctuations, all the way down to speculative, taking the absolute most risk that you possibly can, and all the way to somewhere in between, like moderate, middle of the road, desires big returns and awares that need to take risk, but we hold a wide range of asset classes and don't go all the way into risky equities. Then we got into our phase 3, which is not the most glorious, but probably the most important of all of the phases, because it's actually making sure that everything you've been doing this whole time is still on track to put you to where you want to be. So that includes portfolio monitoring, estate planning maintenance, and tax efficiency management. First of all, the portfolio monitoring. Do we continue to serve our goals and objectives, our cash needs, our risk tolerance, all the stuff that we need it to do? Is it still doing that? So on a daily basis, we're talking about the current events, we're looking at changes in tax code, we're keeping an eye on the activities of the Fed and all that kind of stuff. Weekly, we're measuring the portfolio metrics, we're checking to make sure that everything is still in line and just taking mental note of things that we see, so that later, when we do our monthly monitoring, we can go shopping for new funds that we might want to replace some poor ones with, looking for cheaper funds, looking for better performing funds, lower risk for higher reward, all those sorts of things. See if your old mutual funds have turned into ETFs yet, and see if you're eligible for that exchange, or if you just want to sell and buy some. Looking at your loss positions and making sure that there's nothing in there that is just horrible because it's horrible. If it's down just because it's down, that's fine. If it's just a bad fund, it's a good time to replace it, because the one you replace it with is going to look really good in the future when it makes up that loss. Quarterly, you might dive a little bit deeper into the metrics of your portfolio and make some changes when you need to. Don't make changes when you don't need to. Don't trade just to trade. You don't want to do churning to yourself. But monitor and adjust your allocations in regards to your objective, risk tolerance, income, risk-adjusted returns, and all that fun stuff. Fund expense, one of our favorite ones to go for. Biannually, making sure you're monitoring your portfolio for funds with substantial increases in value, and maybe selling off a little bit of the gains if it seems like it's going to be a short-lived or event-driven something. Like if I had a bunch of NVIDIA sitting in my portfolio and I saw it run up 2 or 3 times, I'd probably shave a little bit off so I could take it and put it into something else a little bit more reasonable. But maybe I'd hold on to a little bit. But it's the most relevant for specialty funds, not usually for total market. If I have a total market fund that's up 5 times, I'm not saying that I would immediately want to sell that off and then go buy a bunch of long-term bonds. That might not be the right move. So it's really more about your overall allocation and how it all fits together. Annually, make sure you're reviewing yourself. Make sure you're looking back on your own situation and see if anything has changed. So oftentimes somebody might come up with a liquidity need, but they don't even think to put that into their plan, and their assets are much more risky than they should be. Make sure you go through your diagnostics over and over again. Every year you're looking at your cash flow to make sure it's still on track, see if anything's changed. If inflation drove up your cost of living, get ready to budget that for your distributions. Otherwise, you're not going to be able to buy groceries next week. Make sure that your insurance is still up to date. Make sure that your estate planning is all correct, like the power of attorney and the trustee stuff that we just talked about. Really important to make sure that no extenuating circumstances are cropping up and taking place of that, and making sure that everybody is willing and able to do the jobs that they're assigned to do. Tax planning, making sure that you're not taking out these same clients, actually. We're taking probably the most inefficient withdrawals out of their assets that they possibly could be. They have a trust with a bunch of money in it that they inherited, so they got to step up in basis when they inherited it. They've got their retirement accounts, and then they get some Social Security, and then I think he gets a pension. So the pension, Social Security, whatever, can't do anything about that, that's great. But they were taking money out of both her IRA before RMD started, and out of his annuity that was in his IRA before his RMD started, while they had this trust sitting here, where they possibly could have been taking out money, and instead of paying ordinary income tax on it, They could have been paying long-term capital gains. So instead of paying 25%, you could pay 10, 15, or if they make little enough, 0 for the first $94,000 or $94,000 jointly on a joint tax return. So just like understanding, like even when I'm just taking money and spending it, there's tax efficient ways to do that too if you've got a lot of different stuff. If I'm sitting here with an individual brokerage account and my IRA, it's more tax efficient for me to take out of the individual, especially if I've held those securities for over a year, because then I get the preferential tax treatment. Or maybe I pull it out and not all of it is going to be taxable anyway, it's just going to be the gains. So the money I put in there, I just get to take back out. But if you go with an IRA, every single dollar gets taxed because you put it in there tax-free. So it doesn't matter which direction the cash is moving. You got to make sure that you're doing it in the most efficient way. So that's another thing where it's just like, you got to see CPA, because this is not. You are literally taking from every least efficient tax vehicle while sitting on this trust that could be funding all of this for possibly 0 tax consequence versus paying 25% on every dollar that comes out.
The other thing on the annual thing is when you get to the point where you have to do the R&D, right? I'm going to get there and I want to plan out 2 or 3 or 4 years that if I have to hit it and take it out, the market tanks, I'm not drawing something else that just dropped in value. So stage out your planned liquidations at that point if you want, or maybe you want to convert money from the IRA to the Roth. You have to plan that conversion because that can trigger Medicare costs, right?
Yep, and then it sticks for 2 years, and you have to wait 2 years until you can recalculate it again for your premiums.
Yeah, so everything changes. I have one account where I'm all conservative, and the other one I add to the 401k, I'm all in the market. It's all emotional investor behavior, time frame, and risk on.
Yep.
The more money you have in your 401k, the more you have to pay for Medicare.
Exactly, but
I know.
the long-term plan, yes, that's exactly true. The good thing about the old annuities that you shouldn't have bought but you got, or the IRAs and not too big, the only benefit there maybe is that if we live long enough, we have to use, we need home care or long-term care assistance. Some of that's tax deductible. So you're self-funding for your long-term care needs. If you don't use it, then you die, that's your beneficiary's problem. They're going to pay tax on it. But it's a form of long-term care reimbursement, let's say. Is that if you don't have the long-term care coverage, I don't know how much of this lady's $200,000 a year home health care that she pays for, but I think the laws will get even more generous because the states don't want to have to pay for your care. So as you pull money out of your taxable retirements, you can offset it. You're self-funding your long-term care if you don't have the insurance. And we all think, oh, I have long-term care insurance. Well, yeah, but it only covers about 1/4 of what you're going to need. So.
Yeah. So then looking at estate planning maintenance, making sure that goals and objectives are met, again, needs and family situations are taken care of. Just like we mentioned with that client example, where that person is no longer fit to be the trustee, yet she was still the trustee. It's important to revisit that and make sure that what needs to happen, happens. And if somebody needs to resign, somebody needs to resign.
Oh, do you remember we had the lady's husband passed away. Her adult son is the trustee, but he lives in Brazil.
Right.
Do you remember that case?
Yeah.
So he and his mom said he needs to resign. He lives in Brazil. He can't be the trustee. And I thought, oh crap. He's got a big ego and all this stuff. This is going to be hard, but he decided to resign. And the brother that lives in Austin. But you'll have these problems. The guy moved out of the country, and then mom needs his help and needs money, and he's not available. And then for us to get money and signatures from Brazil, good luck. You know, that's going to be.
Exactly. Then we went over our account types, different ways that those might affect things like your individual, transfer on death. We talked about the difference between joint tenancy with rights of survivorship and the other two options, tenants in common and community property. Community property is the only one we really care about because we don't have, or we have tenants in common is fine, but we also have tenants by the entirety. That's the other one that we don't have in California that is available in other places, where the interesting benefit of that one is that if one of the spouses gets sued, they can't take property that is tenancy by the entirety if only one spouse owns the debt. So if there's some sort of creditor or some suit or whatever, both spouses have to be involved in order for tenancy by the entirety property to be vulnerable. But again, Here we don't really care about that because in California we don't even have tenancy by the entirety. We just have community property. So community property is one of our most preferential tax treatments in terms of account types, because when one spouse dies, the other spouse gets the entire value stepped up. It's like the marriage died, and that was the entity gifting, or not gifting, but is now bequeathing this property to the individual, basically. It's kind of like, it's almost like you treat your marriage like a trust in a way. And then speaking of trusts, we started talking about trusts, where your revocable and irrevocable trusts. Your revocable, which all the assets stay in your estate. It's easy to modify. You can change your mind whenever you want. And then you got your irrevocable trust, where stuff actually gets out of your estate because it's out of your hands, out of your control, so to say, the guidelines of the trust, and creditors have no access to this. So they can't go after these assets because they're not yours anymore. You gifted them away for their purpose, and they're being held away from you. But with a revocable trust, those are still vulnerable in every way. Then we came up with our estate planning checklist that we grabbed from NerdWallet, and that goes through all the different steps that you should do when you are checking over your estate planning to make sure that all of this is covered. Make sure you create your inventory, account for all your family's needs, establish the directives, so that includes power of attorneys, medical directives, and stuff like that, making sure that all of your wishes will be followed. Review your beneficiaries, make sure that they're all to receive what they're receiving, or if they're not, that they're receiving it in a way that will still benefit them. Note your estate tax laws. Here we don't have a death tax or estate tax, so you don't have to worry about that in California, but other states that might be an issue. Weigh the value of professional help. Now, in our opinion, estate planning and taxes are like two of the things where you can get professional help. Taxes, if your situation is a little more complicated, always super helpful, but estate planning, there's just so many little things, so many little boxes you need to have checked. And it's, yes, you can set up trusts and things online, but it's at least important to just get at least a one-time consult from an attorney to look over all your stuff and make sure it's going to do what you want it to do. And plan to reassess. Just like phase 3 talks about for the investments and everything else, reassess your trusts. Again, that example, if they had reassessed at any time, it looked like she was going to have this condition, she could have resigned from the trust, and this wouldn't have even been a conversation. It would have just been over. So we talked a little bit about tax efficiency management. A couple things that you could do that, during this, the difference between joint tenants with rights of survivorship and community property. Little reminder, the joint tenants with rights of survivorship, only the decedent's half gets stepped up in tax basis, not the survivors, but community property. Both do. However, it's only available to spouses, whereas joint tenancy with rights of survivorship is available to everybody. Dealing with gain positions. So this is something, it's like, again, you can't really avoid the capital gains. You can't avoid paying taxes on the dollars. It's going to happen one way or another. But if you're committed to selling a position, you could consider exploring specific shares method for stocks and ETFs, or last in, first out. So with specific shares, that just basically means you are allowed to say, I want to sell that share, and that share that I bought when they were at the highest price, versus just selling for an average. So if you had bought 100 shares when it was $100, you bought 100 shares when it was 90, you bought 100 shares when it was 80, you could elect to sell the shares that were bought at 100, so you can actually take the loss, and then that's what you get your tax consequences from. And then last in, first out is the default. That's what usually is the method when you sell, is just whatever the last shares were bought, those are the first ones to get sold. And usually in an upward trending market, that's the most advantageous, which is why it's the default. If you're not ready to sell, consider allocating your portfolio around your gain positions. So if you've got a big individual stock, you can just kind of assume that's your equities, and you can allocate around that to make sure that everything stays within the right balance. And then obviously you've got long-term capital gains versus short-term capital gains. Long-term gets preferential treatment, short-term gets taxed like ordinary income. So hold them if you can for over that year. And it's not 1 year, it's 1 year and 1 day. So If it's been 365 days, you still got to wait until the next day, or else you won't get that long-term capital gains treatment. So income-producing securities could drive up your tax bill. That's a possibility. If they're held in a non-qualified account, all those dividends and distributions are taxable to you the day that you receive them. Even if the cash doesn't hit your hands, you still get taxed like it does. So if that's a concern, consider tax-advantaged income securities or growth-focused securities that don't pay dividends, that aren't distributing capital gains and stuff like that. So maybe a growth ETF would be a really good idea if you're looking to not have a tax consequence from dividends being paid or interest being paid. Portfolio rebalancing and allocation adjustments. If we're reallocating non-qualified accounts without considering tax needs, you may want to rethink the relationship you have with that professional, because if they're just generating tax consequences for you out of nowhere, and you are not prepared to budget for it, and it's not what you want, then you should be having that conversation with them, and that should be something that is at the forefront. Automatic rebalancing is not usually suitable for tax-concerned investors, because it will often, unless they are biasing towards loss harvesting, they'll end up giving you a huge tax bill at the end of the year just for automatically rebalancing to keep you in line. When you're choosing new positions, be aware of their characteristics. Check and see if you're buying a mutual fund that pays out a lot of capital gains, or if there's a dividend, or if there's income. Is the income tax advantaged? Are we talking municipal bonds? Are we talking treasury bills? Are we talking corporate bonds? They'll all have different tax consequences, so it's important to understand in non-qualified accounts what those consequences are going to be. So that's the end of our review for everything we've talked about thus far. Now, before we end up wrapping up, what we want to talk about is doing it yourself versus hiring a professional. Because now, up until this point, you've learned everything that you need to do it, if you want to do it. But if you don't want to do it, there's still a little bit more that you're going to need to learn, because you need to know why you would hire a professional, when you would hire a professional, how you would hire a professional, and how that all looks. So when it comes to evaluating the professional help, the things we want to consider are a few. There's what services you're looking for. So how much service am I going to be getting from my financial professional? How am I going to pay for it? And basically, do I like the guy? Does he make me feel good? Do I feel comfortable with this person? Do they explain things in terms I can understand? Are they pushing me to be more educated and be in a better position than I am now? So when you're looking at these services, there's a couple different things that you might want to receive. You might want a one-time financial plan. You might want a printed out document that says, if you do these things every day into the future, starting from this date, you will be there. There's a lot of software that can do some really complex simulations, and basically they're Monte Carlo simulations, which basically throw all of the possibilities into a computer and give you the percentage chance you have of succeeding. So generally, when people are making financial plans, they keep adjusting it until you get this like 95% plus probability of success, and that's how they determine if it's a good financial plan or not. Now, those can be useful, but oftentimes things are more variable than that. You usually are not going to follow your plan perfectly for 20 straight years. There's probably going to be some differences, some changes in cash flow. The things are just variable. But a one-time financial plan can have its place. Those can end up being a few $1,000s. You can have ongoing asset, which is the stuff that we specialize in, where you might have somebody that just takes care of the allocations for you. You tell them what your situation is, and they allocate the funds, they manage everything, they make sure you're not getting hit with tax bills, whatever the case may be. That is another type of service that you could get. Guidance on a case-by-case basis. So you might come in with some particular things. You might go to buy a house and you want to know, what are some things I should do? What would be most efficient for me? What resources do I have to pull from? Those sorts of conversations are also things that financial professionals can be very helpful for, is when you are doing stuff in your life to just run it by your advisor and see how it fits into your overall picture. The more service you require, the more an advisor can help you. The more that you have to, the more help that you need, the more they can help you, obviously. But it's just like, if we're just drilling down to something like a one-time financial plan, sure, that's going to be helpful, but there's not much of an ongoing basis for that. Versus if you have somebody that's constantly looking at your assets, constantly looking at your situation, having lots of conversations with you, data going back and forth, that's going to make for a really good relationship because they're going to know what you need before you even ask for it at that point. So when you are able to really have that conversation and go back and forth so they can be anticipatory of your situation instead of reacting when you tell them what's going on, that's when you get the most benefit out of a financial advisor. So then we move on to the money situation. How are they going to get paid? There's a few different ways that financial professionals get paid. You can simply just hire them for every hour that they charge, like you would an attorney. You can pay hourly rates. You can pay retainer fees for the year or for the month, whatever you desire. If you want to just keep them on, if you don't want to give them assets. They can sell you products. So you'll see this very commonly with insurance products or variable annuities, or back when they were selling A shares and B shares and C shares and all that sort of stuff. They might sell you a product that is the solution to whatever problem, and then that's how they get paid. Now, the only problem with commissions that we see is that it does subconsciously bias them towards the things that are going to pay them more. So even if they don't flat out say it, they're probably going to be a little more biased to sell you the variable annuity versus do the asset allocation, because they'll get this nice upfront check, just nice big check that they can go and have a nice big steak dinner with on your dime. Then there's percentage fee of invested assets, or assets under management, abbreviated AUM, or sometimes it's assets under advisement, AUA. But generally this will be where you see that 1% of everything you have invested. They'll charge 1% for doing all the asset allocation and for doing the other services. So remember that too when you're paying for your financial professional to manage your assets. That fee is also paying for all the clerical work that they do, all the phone calls that you have, all the meetings that you have. That's why you're paying that fee. It's not so that they can beat the market for you. It's one, so they do the job of asset allocation for you, and two, so they do all the consulting work too. So take advantage of that and speak to your professional and get your money's worth. Selecting an advisor. It's a little bit of a process. First of all, you got to be able to trust them. You got to feel like you're not getting dragged around or trying to sell you an annuity and it's just not proper for you and you know that, then obviously that's not the professional for you. Make sure you look them up on something like Broker Check, just in case. You never know. I mean, I have horror stories from people who gave people tons of money, millions of dollars, and it just disappeared. It's just gone. It's just gone into the ether, and they were never a licensed professional, so the ramifications don't hit them till way later, till they're tried and charged by the SEC and all this fun stuff. But if you make sure that they're licensed to do what it is they say they're going to do, it's much more likely that they're actually going to follow the rules of the game and provide you with what you need. The other,
deep pockets, right?
Yeah, that too. So if they're with a big firm, that means that if something happens, that firm has to compensate you because they're responsible for their representatives. So on Broker Check, you can also see if they've ever had a complaint against them. So if somebody has sent a complaint to the SEC, that will show up on their Broker Check. So will certain crimes that they've committed, like misdemeanor assault or something like that, will show up on their Broker Check. So you can see if your advisor was a little bit of a hot-headed guy back in the day. You can also see that. Figure out how they're making money. Everybody's going to make money in this business. That's how it goes. That's why most people are in the business, is to make the money. But just understand how they're doing it. If they're selling a product to you, that can be fine. But oftentimes, again, like I mentioned, people will end up being biased towards the things that pay them the most. That's just kind of how it goes. Versus with an asset under management fee, we get paid more if you make more. So, yeah.
Question, on mutual funds, most of the funds I see, stocks, they give you A shares. Are those tend to be more expensive than the other shares?
That stock versus fund, right? A stock might be an A share that has nothing to do with a fund, but a fund could be an A share, a totally different story. Right?
Yeah, I'm not 100% on the difference.
Okay,
I
so
don't even
you'll
sell
see
that.
stocks, like, I don't know if it's Google or somebody has an A-share class,
Right.
or Warren Buffett's thing. And because they got too big, they came out with an A-share or a B-share and a stock, that's fine. But in a fund, an A-share means we just charge you 5.75% upfront, which can reduce down. If you'll give us $1 million, we'll eliminate that commission and pay the broker on the side 1% just to get rid of them. But then you're stuck with that company. You can move around, but then now you've got all American funds or all Franklin funds, or you can't go anywhere else. We'd rather have a diversity of fund companies plus low cost at that point. But yeah, A shares a stock, that's just not a problem. Just different animal. Do your homework. But funds A, B, and C, or do you have those on the slides or?
I think we had them before. Yeah.
Okay, so A, B, C shares. I'd stay away from mutual funds like that. Just stay with the total no-load funds.
Yeah, and most of the time, if you're especially if you're investing through a financial professional and they're doing like AUM services, they're buying you institutional or advisor shares, which don't have those commissions and usually are much cheaper and stuff like that.
Over the years, I found mutual funds that I've had, and I've traded out some over the years since I've been in this class. But most of the funds have A shares.
Yeah, those are bad. Yeah, it's kind of like when I show up to do your roof, and you pay me before I. Well, you wouldn't do that, right? So if the broker gets, and they probably keep half of it, but if the brokerage company gets 5% up front, that's 5 years or more of work they should have been doing. But you pay them all up front, so we're not surprised why they never answer the phone, right? Yeah, so
Yeah.
mutual funds, absolutely. But if you have old A shares and they've appreciated, be careful because you could pay some capital gains tax. So that's why you feather it down over several years. And then if you're not sure, just go to Vanguard. Theirs are all cheap anyway. Fidelity, you've got some good
Yeah.
Fidelity.
Yeah. So again, just understanding how they're getting paid, what it is that they're doing that is worth that money, and making sure that you're getting it. Making sure that they can explain your financial situation to you in simple terms, in ways that you can understand, and that they can provide solutions that you also understand why they're beneficial to you, and at least they can explain that. I would love to see an insurance salesman tell me why annuities are so much better, and I would love to sit through that conversation. Maybe I'll go to one of their sales pitches at a luncheon sometime and see, get a nice free steak dinner, and I'll let them try and convince me to sell my clients annuities. I'll see what that's like. Haven't been to one of those in a while. I think it's about time. Anyway, also, do they respond to your communications pretty fast? Because I have been shocked to hear some people who have come over to us who talked about, like, yeah, I was calling my advisor for like 6 months and he just never got back to me. What do you mean he never got back to you? He's managing your $1.5 million. He's not talking to you? And they said every time we'd call him, he'd be on vacation. I go, oh, that's great. That sure shows a lot of dedication to managing your finances. So it's just like making sure that if you're paying somebody a % to manage your stuff, they should at least be able to call you back in a week. I feel like that's reasonable, right? That seems pretty reasonable for them to be ready to call you back, even if, sure, maybe if there is a little bit of time, but at least they'll get back to you, because you need to be able to have these conversations. You need to be able to share information back and forth so that they can understand and apply it. Otherwise, what was the purpose of them being there?
But are the regulators catching people? Because in one case, we heard about an advisor who took money, shipped them off to the home office. They managed the funds, and they were okay, right? A lot of iShare funds that they charged a fee to manage it. The advisor didn't have anything to do with it. He just shipped them off and got part of the management fee and was supposed to do the financial planning. But the same advisor said, let's take this $450,000 annuity that's in your IRA. I got a brand new one for you. That's extremely inappropriate. Not only should annuity that's tax deferred not be in an IRA, but he's going to get a big whopping commission. And we're just thinking, wait, you hear us say, I'm a fiduciary, but in this case, this guy had fiduciary services, but he was also doing things that were highly unethical.
That doesn't mean that he's not a fiduciary.
Okay.
I just want to, like,
Acting that way.
so fiduciary is also kind of a discretionary term. Like, there is no definition in terms of the math. Like, I could, if I'm convinced that an annuity is proper, and my research shows that, and I sell it to you, I'm acting in a fiduciary capacity.
But if I'm my client's attorney and I say, was that annuity appropriate in an IRA? And you got 5 or 10% commission up front.
Right, but he didn't get paid management fees on that.
I guess so. So.
Yeah, so again, it's just kind of understanding how they get compensated.
Well, in this case, it might be legal, but they're closing the window because they're getting really strict on all this stuff. We don't sell annuities, but if we did, you have to go through an onslaught of questions and answers and disclosures. But it's just frustrating that people are out there doing this stuff. And why doesn't this guy just manage the money? You'll get 1/10 of 1% a month, and over a few years you'll make some money. But they want the money right now. And my thing is, I think it's crazy. It hurts the advisor more than the client, because if you buy A shares at American funds and pay a commission, but you stay with all the American funds for 30 years, the commission went away and you had lower cost good funds. The advisor's out of a job. I mean, don't be greedy. Just pay the. You'll make good money, but it's too bad.
Yeah. So some things to avoid. Obviously, make sure you're avoiding unlicensed activity. Can't believe I have to really say that, but I know more than one person who has succumbed to that. Unregistered securities. So the thing about unregistered securities also is now that actually is starting to apply to is crypto, which is really interesting, because we're in this sort of interesting game with the SEC where they're trying to figure out how are they defining a security when it comes to crypto. Because we know what it is when it comes to stocks and bonds. It's pretty easy. If we see it's a share of a company, we say it's a security. If we say it's a bond that pays interest, well, it's a security. We have to do that. The only thing that's not a security is government debt. That's not a security for whatever reason. It kind of is, but you don't need to be registered as an advisor to sell it to somebody. But with crypto, we're starting to figure out, where does this line get drawn? Because if I remember correctly, I believe Bitcoin was deemed a commodity. And that was interesting. So that kind of gets you into some back and forth sort of games. So when we're looking at our portfolios, just don't get into things that haven't been defined yet. It's fine to be interested in them and maybe to do some little bits of speculation, but when we're looking at unregistered securities, that just brings another level of risk. So really, that's what we're looking at. We don't want to increase our risk by tenfold because we just haven't figured out what's going on in this industry yet. Unsuitable recommendations, that's where we would argue that the annuity in an IRA is not suitable, where they would probably be arguing for the income guarantee, they would probably be arguing for the downside protection, but we would be arguing for the redundancy of tax deferral. We would be arguing for the high fees and all those sorts of things. So there is some wiggle room for what can be considered suitable, but for the most part, it's all the stuff that we talked about before, making sure it fits your time frame, making sure it fits your needs, and will accomplish your goals. Again, tax deferred redundancy, like we just mentioned. Account churning, so if it's a commission-based account and they're trading all the time, that's unethical and illegal, so they can't actually be doing that. And reverse churning, which would be like if we just bought and held and never did anything, but we charged 1% every single year, is that worth that fee? That's why we actually do have a requirement internally to do a trade every year, or else it starts ringing red flags. For the most part, we're kind of rotating in and out of stuff more frequently than that, so it's not a problem, but there is a requirement that you get a trade a year on your accounts. Obviously, if they're doing stuff without your permission, if they're moving money around without talking to you about it, that's horrible. One of the people that I was working with, there was some split of the management, and there was some other firm over here, and there some referral business, and they were like, we're going to move $400,000 over here. Is that okay? And she was just like, yeah, okay, I suppose that's fine. But she didn't really understand what was happening, because what was happening was they were going to sell everything, trigger tons of capital gains, move it over, and then she got stuck with a tax bill, and she was like, what do you mean I have to pay $30,000 in capital gains tax? I didn't do anything. But just because they sold out of these American funds to go buy other ETFs, that triggered tax consequences that was never part of the conversation. conversation was never had. So she didn't even know that this was coming, that there was going to be this huge tax bill that just like all over that she had to budget for, and just became like for a year, all of the cash reserves just went to the tax liability. And now there's no emergency fund to rely on. I had to build that back up. So making sure that all that is good. And then obviously your Class A, B, and C shares for mutual funds, those end up getting expensive. So when you go with advisors, somebody like us where we have the big firm broker-dealer behind us, again, we're usually with advisor shares or institutional shares, which are no fee or no commission, low fee. That's usually the least expensive ones that you can get. So deciding what's right for you, ultimately, the time you have left is your most valuable asset. The minutes, seconds, hours, days, and years, that's the most valuable thing you have, not the dollars in the account, not the house, not anything. It's the time you have left. So if you like doing this, if you like all of this and you love studying it and applying it and all that fun stuff, then do it yourself. And that's great because you'll enjoy the time you spent. But if you don't want to do this, that is your sign to hire a professional. That's when you should be doing it, is when you don't feel like putting the time in, because you want somebody else to spend their time, same time that you would spend their time doing it. Get their experience, get their years of experience, get their hours of studying, get their hours of watching the news and doing this and paying attention to all these things. That's what you want to pay for. You want to pay for somebody else to do it for you when you don't want to. You can do all of this. Everything. That's why we're teaching this class, because you can do all of it. But if you don't want to, that's when you hire somebody. The more complex your situation is, the more a professional's expertise will be valuable, because they'll think of things that you just had never even crossed your mind. They'll think of tax breaks, like a CPA will be able to just come up with different things, like just hiring a good CPA. They'll figure stuff out for you that you would have never imagined. An estate planning attorney will go, there's this vulnerability right here to where if this person is not whatever, then this transfer can't happen and it goes through probate. They'll catch all those things because that's the industry they know. We will look at things, and like we were looking at bonds, we were thinking we don't want to be in long-term bonds because interest rates are so low. When they start going up, it's going to kill our bonds. And guess what happened? The interest rates went up and the 30-year bonds fell through the floor, dropped like half in value. So just knowing that you got to stay up on all of it or not and hand it off to somebody. But just understand which direction you want to go in, because both are totally fine.
Keep one thing in mind is a lot of the firms advertise, we have attorneys and CPAs all in-house, come with us. That's great, but do we want them all on the same team? We would rather have independents shooting me down saying, are you sure about this guy? He's like, Mark, I'm not looking at what. We want different views versus a whole team of everybody's getting the paycheck from the same place. So it's not a bad thing, but if you go with a big company and they've got in-house attorneys and CPAs and everything, that's nice, but at the same time, I'd like to have independent consultants that aren't on the same team. We just think it's a little more wise. Find out later that they all agreed on something that wasn't to your best interest. Yeah, yeah. And that's fine, but if I own the company, it's just easy to get in trouble that way. If everybody's on the dole, so to speak, and they all have the same password and the same information. So yeah. We want to check everything out, because like Nash is saying, if you do your own investing, try to find out as much information as you can. And now you have YouTube. You can watch YouTube's. Nash has all these classes on YouTube, or other attorneys, CPAs. If you're interested, you can dig deeper and know more than any advisor knows. But do you have the time? Seems like that's all I do at Starbucks, is try to figure out how to do these damn, computer programs or research and stuff. But
yeah. So ultimately, there's not going to be a perfect answer for everyone. So go the route that gives you the freedom to live the way you want to live. If the way you want to live is doing all this research and doing this for fun, have at it. There's plenty to be done. And trust me, the game never ends. But if this isn't what you want to be doing with your life, that's when it's time to make the decision to finally hand over the keys. So with that, thank you guys for attending and for sticking all the way through. It's been a long 12 weeks, but we made it again. And if you have any more questions, anything you want to ask, now's the time. Otherwise, Take business cards and call anytime.